We are live on YouTube. Okay. Pratiksha, are you
Yes.
ready?
Yes.
Okay. Saili, shall we start? Atul sir? Atul sir? Saili, are you there? Saili?
Yes, I think it was like muted.
Okay.
So, yeah. So
Please,
I would also
please.
like to share the screen. So
Yeah,
if,
definitely. Once we have the formal introduction, everything, we'll start and then we'll allow you to
mhm.
share the screen.
Okay, fine.
Okay. Uh, Pratiksha, all controls in place.
Yes, sir.
Okay. Please check clearly all controls in place.
I have sent you the link. You can check once.
Thank you. I got it.
Yes.
Okay. Just check. Are you confirmed, Pratiksha?
Yes, sir.
Ashray, would you also check once all control in place?
Um,
I'll check, sir.
can you make Saili ma'am the co-host?
Yeah, 1 second.
Yeah.
Ashray, all good to go?
Yes, sir.
Okay. Pratiksha, and
Yeah.
we can start now.
Okay.
Good afternoon to one and all present here. I, Disha Agarwal, the technical assistant of the club, Casa de Dinero, by the BBI Department of HR College of Commerce and Economics, would like to welcome you all for the highly informative webinar on risk management in the banking sector. The Banking and Insurance Department has created the club Casa de Dinero, which means House of Money, to help students gain knowledge about the multifaceted and dynamic industry of banking and insurance sector by providing a platform for the students of this course to explore the industry beyond the pages of their books by bringing some of the most influential and experienced minds from the banking and insurance as well as the finance sector. Casa opens its doors for the students to understand the nitty gritties of the sector and gain real life experiences from professionals themselves. This club would not have been a reality without the support and guidance of a faculty in charge and course coordinator, Professor Rahul Mishra. I thus request you, sir, to give the welcome address.
Thank you, Disha. And on behalf of HR College, on behalf of HSNC University and HSNC Board, let me take this opportunity welcome you all to this one of the important sessions when we talk about the banking sector. Every time we are calling different people from different sectors. Right today, we got an opportunity to call our very own alumni, a bright student right from first day in college. I remember her, a person who has always had doubts in her mind. Always comes to what to do, what next to do, what should we learn, how to develop our skills. And today, I'm very happy and very proud that my student is here with me to guide and mentor the others. So today's topic, which is taken, she's already into working with Crystal earlier with EY, and today she's working with Crystal as a risk analyst and doing great in her career. And I'm very proud that my student is there today to discuss and talk with us. So, my dear friends, the platform is created for such kind of webinars, workshops, and many other things, many activities in times to come. You all are here. We already done one seminar earlier where we talked about the entire evolution of banking sector. And today we are catering to one specific area, and the most important area today is talk about the how to manage the risk. Risk is everywhere, but specifically sector-wise, what different risk is there and how to manage that, which we'll talk by Sally today. So once again, let me welcome Saili on behalf of HSNC University, HR College, and the HSNC board, and everyone who are here. And without taking much me time, me only talking, let Saili do talking. And before that, I call upon our team members to the formal introduction.
Good evening to one and all. I'm glad to welcome you all to our second event. I would like to give a brief introduction of our speaker for the day. She has done her majors in banking and insurance and worked 3 years after graduation with operational risk practice of EY. She has worked for public and private sector banks in India, as well as European investment banks, assisting them to set up operational risk and enterprise risk practices. Recently, she has joined Global Research and Risk Solution practice of CRISIL Limited, where she is helping with operational risk management exercise. Apart from her professional interest, she also takes keen interest in reading, cycling, and solving puzzles. I would like to welcome you, ma'am. Over to you.
Thank you. Thank you so much, Professor Rahul and Aparna, for welcoming me, giving me this platform. Also, heartiest congratulations to HR College on becoming a full-fledged university, as well as I'm seeing so much of improvement with this club and so many speakers coming in, and it's so dynamic. I'm so happy to see how the college has progressed, how we have progressed as banking and insurance. I remember when I joined banking and insurance around in 2014, it was just a mere course. But from there, right now, we are coming to this kind of industry academia, linking and bringing all these people on board, bringing all these newer topics into discussion. And there's a lot to do in this field, of course. So yeah, thank you for inviting me and such, and also thank you for taking this initiative to taking banking and insurance to another level. Now, banking and insurance is very, very personal to me, obviously, because I studied for 3 years. Apart from that, I'd been very, very lucky to work for the same things that I studied. So I studied the Basel, I studied the, banking balance sheet and insurance balance sheet. I studied, IRDA, RBI, and all of that I'm doing in and out, day and night, right? So I'm very grateful that I've done this course and under such good name, right? So as Aparna has already introduced me, I work for the risk management practice. I was earlier working with EY, where banks and insurance companies were my clients, and currently I'm working with CRISIL, where again they are my clients. So this is completely in my personal capacity that I would like to tell you about some general practices of risk management which are followed in the banking and insurance sector. Now, I know it is I know it is Saturday afternoon and most of you are, keen on spending your weekend in a different way. So I don't want to take a lot of your time with a big presentation, but I'm going to make a small presentation here. So let me know, you can see my screens, right?
Kylie, just one thing, just put the annotations off, just a reminder.
Yes. Where would I find that? Sorry. Okay, let me just share again.
At the top, you'll find where the three dots will be there when you share the screen. On the top, the control panel will be there.
Yes,
Sir, it's
yes,
already
yes,
disabled. So it's
Okay, fair enough. Kylie, you can
proceed,
continue.
ma'am.
Okay.
Yeah.
Okay. Give me a minute, please. Yeah. Okay. How many of you know this guy? Do you all know this person? Sorry. Most of you might be knowing this person, right? He is Vijay Mallya. He has, taken loans from the bank, has not repaid 17 banks, and is now out of the country, right? Most of you might also be knowing these people, right? This is Chanda Kochar and Deepak Kochar. Again, a banking fraud where, money was lent by Miss Kochar to, a firm which was run by her husband through Videocon. So this was an other banking fraud in public light. You definitely know this one. You definitely know Nirav Modi and how, he defrauded Punjab National Bank. It was an internal fraud where the person who was handling the task, helped Mr. Modi defraud the bank. Okay. So there are various types of risks that the bank is facing, right? Then why is it lending? Why is it lending even though people like these are defrauding the bank, are taking away the money? Because, of course, like Harshad Mehta said, risk hai to ishq hai, right? Okay. So first of all, to understand, what is the risk and what is the ishq, we first try to understand what is a bank. And I think this definition you're going to find in all the 6 pillars of banking. So definition of banking company says that it accepts deposit of money from the public in order to lend or invest or repay, and it is repayable on public demand. Okay. So what I am doing as a bank, I'm taking say 10 rupees from each of you. I have 100 rupees now, considering say there are 10 people giving me 10 rupees. I have 100 rupees now. Now what I'm doing, 60 out of which I'm giving it as a loan to say some other person, 40 rupees out of which I'm investing in the market. Okay, so that is what I'm doing with the public money. Now, when I'm doing that, of course, say one person of you comes back and tells me, give me back my money, my 10 rupees, then it is my obligation to pay you back the money. So that is why it is repayable on demand. Now, this whole definition of banking is why risk management in banking becomes very important. So we are going to focus on the words lending, we are going to focus on the word investment, and we are going to focus on the word repayable to public on demand. Okay. So what is the ishq here? The ishq is the profits, right, that the bank is making. And how is the bank making that profit? They call it net interest margin in the banks. So this margin, how they are earning is the money that they lended, right? The 60 rupees that I lended, say I'm earning interest on it of 20 rupees plus the 40 rupees that I invested in market, I'm earning an interest on it, say 10 rupees. Now I have 30 rupees. Okay. So all of you come back and say that give me back my money. I will say, okay, take it, plus take this 5 rupees interest. So now I already had 30, plus I'm returning you your money with an additional 5 rupees. So 30 minus 5, 25, which is net interest margin, which is the profit of the bank. Okay. So taking that risk to lend, to invest becomes very important because ishq hai to risk hai, right? Because you need profits. So what are these 3 important risks in the banks? First risk is credit risk. Second one is market risk and operational risk. These are the 3 main risks on which entire banking is, dependent. There are other forms of risk like reputational risk, compliance risk, strategic, legal, information security. So let me talk in brief about some of them. Credit risk is when, you are lending that person, say 60 rupees. He told you he will give you 80 rupees back. Now he is not paying back the money. That is credit risk. That my money is lost. My 60 rupees are lost. Market risk. I'm investing 40 rupees in the market. I think that I'll get say 50 rupees, but markets crashed. Okay, Corona ho gaya, no business at all. Markets are completely crashing. My 40 rupees are lost. So that is my market risk. And operational risk, if you see, I've put it in 2 colors because it is a mix of all risks which leads to other risk. For example, the Nirav Modi scam that happened, right? What happened? It was, actually a credit loss. Actually, that Nirav Modi could not pay back. But the problem was on operational level. The problem was on the person who was sitting over there and doing this process. So when it is a process related or people related problem, which is leading to a credit risk, that is a person not paying you back, or leading to a market risk that you crash in the market, that is an operational risk. Other risks that the bank face is something like reputational risk. ICICI faced a very big reputational risk, right? The stocks completely crashed of ICICI when Deepak Kochar was arrested. Compliance risk, that is, there are various RBI rules and regulations which a bank has to comply with, like keeping a X amount of capital, doing all this risk management practices. So RBI comes and checks all of this. And if any of it is not done, that will be like a black mark on the bank. So that is a compliance risk. Next is strategic risk, that your peers are doing better than you, right? I think ICICI, HDFC, all these banks are constantly facing strategic risks. Then you have legal risk, that is someone suing the bank. Okay, some wrongdoing, some deposit is not paid, some investor or some depositor goes to the banking ombudsman. So all these become legal risk. Then you have information and cyber security, which are the biggest risks in the bank, right? So like your ATM frauds, your online transaction frauds, your phishing, farming, someone promising you, calling from Kotak and saying, give me your credit card number, and things like that. So these are other information and cyber security risks. But all of these also fit somewhere between credit market and operational risk. That's why in banking language, or like in risk language, in risk universe, we call them other risks, and we focus our whole attention on credit market and operational. Because of these are in place, we think that all these also can be managed. So how do banks manage these risks? I think this might be in your every textbook, and trust me, working for 3 years, I've seen actual application of each of this. So one is risk reduction, where you're doing certain techniques because of which your risk is reduced. For example, say there is a person, say there's a person A who goes to buy a loan. Okay, the bank officer sitting over there ticks all the parameters ki theek hai, sab sahi hai. But if there is no manager over there and directly this loan is sanctioned, can you guarantee that person A will default or not? No, right? He can default. The risk is very high. But say the loan officer who is doing said it's all fine. Then the application goes to his manager. The manager also says all fine. Then it goes to the boss of the manager, who is the senior manager, and he says, oh, okay, this thing is wrong. Okay. So here, what I'm doing is reducing the risk. Because I have like 6 eyes, like 3 people checking the application, my risk is reduced. Risk is still there. Still the third person can miss it, and this person can default. But at least I can reduce it. So on a very large instance, all the banks try to manage the risk by risk reduction. Other types of risk managements, you do risk transfer. That is, you take an insurance. For example, there are depositors, there are 10,000 depositors who are come. Now there is 10,000 in my bank. But I know through investment and all, through lending and all, I'm only capable of raising 8,000. Tomorrow, if this 10,000 people come, I am capable of paying only 8,000. So now what do I do of the 2,000 rupees? I take an insurance. I tell the insurance company, I pay a premium to the insurance company and say that, please cover me for these 2,000. If these guys come, please pay them the 2,000 rupees. So that is called risk transfer. Next is risk acceptance. So I know that something is a risky venture, but because it is good for my strategy, because it is good for the reputation of the bank, or I think that intuitively it is a profit making profit making conduit, in that case I will accept that risk. I will say, okay, there is a risk. I know this 90% of chances that this firm is going to default on the loan, but I will still give it loan because other parameters are good. Okay, so that is risk acceptance. Next is risk avoidance. I absolutely don't get there. I'm not giving only the loan, okay, to this person who I think is going to default on 90%. So acceptance and avoidance are very, very, vaguely followed in banks, or rather, I stand corrected, are, less followed in the banks. Banks mostly focus on reduction of the risk. And that is what we talk about as risk management in banks. Okay. So coming back, what is a credit risk? Again, like we said, it is the loans or the assets of the bank, right? The banks, whatever they are lending, if you all have already studied the banking balance sheet, it says that whatever the loans are given by the bank are assets of the bank. Okay. Now, suppose this loan is given to a person and he is failing to pay it. He's failing to pay the interest. He's failing to pay the capital. Okay. In this case, if this happens for more than 90 days, this person has not paid the principal or capital, then it is called as non-performing asset, NPA. I think you all have might have read it a lot of times. What is an NPA? And a lot of headlines are making these days ki itna NPA ho gaya, utna NPA ho gaya. So exactly what is NPA? It is anything that is above 90 days. But does that mean below 90 days there is no risk? No, right? So banks also, to classify as NPA, give own kind of leeway to the borrower. they say that okay, agar 30 days ke upar ho gaya, to we'll call it substandard asset. So there is no default, it's called standard asset. Then we call it substandard asset. मतलब इतना खास नहीं है लेकिन ठीक है, करेगा, it will perform, it will give. Above 90 days it becomes non-performing. Why do we call it non-performing? Because there is no money coming in on that. I gave a loan of 60 rupees, now it's just sitting, I don't know what to do. The person is absolutely not ready to pay me, so that money is just sitting idle. That's why it's a non-performing asset. Okay. After understanding credit risk, we will understand what do banks do so that such situations don't arise, or if such situations arise, how will I as a bank, attend or balance such situations? What will I do? How will I manage? Okay. Credit risk, for that matter, all types of risk, we divide essentially into two parts: portfolio level and borrower level. Let me first talk about portfolio level. So I told you I have 60 rupees to lend, correct? Now that 60 rupees, what I will do as practice of risk management is I will not lend it to only one person, or I will not lend it to one person for say only house loan. I will lend it to him, but say as as a car loan, as a personal loan, as a travel loan, as a house loan. 20-20-20 I'm lending to him. That is called product diversification. That is, you don't lend only one type of people. Okay, you don't lend only to one type of not people, for that matter, to one type of product. You're lending to different types of products. So that's called product diversification. Second thing that I do is, when I'm lending this within product diversification also, I will not lend that 60 rupees say to all the businessmen who are in real estate. Okay, I'm not going to do that. Out of that, say 10 rupees I lend to real estate, 10 rupees I lend to boys who are in financial sector, 10 rupees I lend to all the people in oil and energy. So what I'm doing is sector wise diversification. So that even if this person says ki okay, abhi to production nahi chal raha hai, corona hai, the factories are not working, production nahi chal raha hai, I'm not getting my salary, so I'm not going to pay any of your loans. Jo tum mujhe car loan, personal loan, house loan diya hai, I will not pay any of these. But there is a person in BFSI, okay, who is saying ki theek hai, I'm to working from home, I'm getting 60% of my salary, I will still pay my EMI. So at least from there I'm guaranteeing ki paisa to aa raha hai. So product diversification, sector diversification. Third kind of diversification that they do to manage credit risk is region wise diversification. Okay, so they are not just lending in Mumbai, they are just going to lend in Delhi, they are going to lend in Kolkata, they are going to lend in Chennai, they are going to lend in Kerala. So all the places over there. So tomorrow if say someone whom I have lending in Chennai, okay, say he took all the three loans, product diversification bhi ho gaya hai, he is from BFSI, but there are floods in Chennai. Okay, now what happens? Now again he is not able to pay, so Chennai mein mera pura paisa doob gaya, it's not coming back. But there are other parts of the country where I have lended, from where some money will come back. Correct? So that's region wise diversification. So these are the three main diversifications that the bank do. Third thing what they do is they do capital for contingencies. So what they assume is, they do certain kind of probability checking. We will not get into calculations, but they calculate a probability that even after doing this diversification, how many people will not pay me. They look at the past data, they look at the forecast, they look at how businesses are running, they look at how other countries are lending. So looking at all of these, they try to forecast, how much of my money do I still stand to lose. So doing this forecast, say they come across that, okay, out of 60 rupees I lended, whatever I do, 10 rupees are sure to go. Okay, nahi gaya, it's well and good. But agar gaya to, so that's why what they do is that 10 rupees, they mark it against their capital. I'm sure everyone knows what is a capital in a company, right? The initial capitals, paid up capital. So they mark it against that, in case of liquidity, and the last thing I have to do is I have to touch my capital, because I am obliged, right, as a bank to pay my depositors. I can't tell depositors, no, uska to paisa dub gaya, I can't give you any money, right? He did not pay me, I will not give you money. So I am obliged to pay my depositors at any cost. So what I'll do, the capital which I introduced in the business, that capital I will mark off 10 rupees, that in case of contingencies, in case I have to pay my, depositors back, this is the money that I keep aside to pay my depositors back. So that is my last resort that I do. That is keeping capital for contingencies. That is what they do at a portfolio level. Second part, they do certain things at borrower level. So say A is coming to take a loan. First thing what they'll do with A is they'll do credit rating of A. What is his age? Is he married or not? How many children does he have? How many family members he has? Where is he working? How frequent his cash flows are coming in? Does he have any credit card? Has he always paid his credit card bills on time? Does he have any other loans? Okay, so all these are like points given to a particular individual. Say he's not paying his loans on time, so he gets 0 out of 10. Okay, say he is like working for a very good firm and earning a salary of 5 lakhs per month. Okay, now he is getting 10 on 10. So it's a whole scorecard where every parameters will be rated, and out of that there'll be a total score which will come. Okay, so say the person applied for a loan of 10 rupees and this scorecard is of 10 marks. If the score is like 6, they will tell him we'll give you a loan of 6 rupees. If the scorecard comes to 8, they'll say I'm giving you a loan of 8 rupees. Okay, now if the person still wants a higher loan, they will say, okay, fine, we will take that risk. We will give you that extra loan, but you give us a collateral. So that is what you hear, correct? When you're taking, say, student loan, collateral dena, house loan, collateral. Okay, these are the words we hear every time. Collateral, pledging, hedging, all of them come to the same thing, ki kuch to do against which we can give you the money. Give us something against which we can give you money. Okay, so that is one part that they do while giving the loan. Now, after giving the loan also, they do monitoring. Okay, so they do monitoring of the loans, whether that person still is living in the same residence or not, whether his contact details are still same or not, has he recently changed his job, how frequently is he changing his job. Okay, they even come and do site visit whether he's still there in that position. They actually do site visit more for big corporations, but let's keep this example simple. So all these kind of monitoring of loans are also done. Next thing, very important thing, is early warning signals. They start, so when they're monitoring these loans, they keep collecting data. And when they're collecting data, they keep, looking for a sign. They keep looking for, something that is going out of the box because of which this person might default now. For example, when you're taking a loan, your credit score is very open. Okay, now it's like available with all the banks. So say this person suddenly purchased something of 50,000. Okay, he already had a loan and all. Now he's suddenly purchasing something of 50,000. Red flag. Maybe he will default on my loan. He took something, not that, once he took, so they will directly question him, but it's a red flag. They will keep on monitoring it. Is it that every time it is happening? Is it that it was just a once-off event, but he still paid? Then they will be like, okay, fine. But say every time this person is taking new loans, now that is a red flag for me as a bank who has already given him a loan. Okay, so these are certain early warning signals that banks monitor as part of credit risk. With that, we wind up how credit risk is managed in banks. Are there any questions?
I will take the questions at the end.
Is there
So that'll
anything
be,
in it help
that-
you?
we'll take the questions at the end. So that will be easier to manage
Okay,
it
great.
further.
Great. Okay, great. Okay. Next, we'll move on then. We have market risk. So like I told you, market risk is any money that I'm investing in the bank. Investing in the market and I'm losing that money. So as individuals, we have always heard from our family members, from our fathers that, equity may invest karo, mutual fund may invest karo. So as individual, your fathers or say your parents are always investing in something or the other, correct? All their surplus money. Same way, banks also have some money which they will go and invest. Now, in what do banks invest the money? You all have, studied up till now what is What are things like money market instruments, what is interbank lending, then what is repo rate, reverse repo rate. All of these essentially collate to bank investing that money. When you're saying repo rate, it is investing with the RBI, that is, it is taking money from the RBI. When you are saying say interbank lending, call rate, what it is essentially doing is it is giving surplus to some other bank and within 15 days asking for interest. Okay, so all this investing of money that a bank is doing, okay, falls under market risk. Now market risk also needs to be monitored constantly. They need to see. So what they do for market risk management, again we have it at a portfolio level and then we have it at a product level. Portfolio level matlab all the places where I have invested money. Okay, here when I say product diversification matlab I will not only invest say in I will not only invest in money market, I will invest some money with RBI, I will invest some money in equity, I will invest some money in mutual funds as a bank, okay. So what I'm doing is I'm doing product diversification. All the 40 rupees that I have, I'm putting in like 10 different things. Say I'm buying again a derivative product. In derivative also I'm buying like a gold backed derivative and a cotton backed derivative. Okay. So within that also we are doing diversification. All this guarantees that say tomorrow gold prices fall and from gold derivative I'm not earning anything. But at least from my other instruments I'm still earning. So that I'm again able to honor my commitment to the public that I will pay your money back. Okay. So that is product diversification. Next, we have calculating and predicting value at risk. So value at risk is same like, where banks kind of, put a figure that this is the amount of risk that I can take. And isse agar kam hua, to I'm not going to deal. I'm going to stop my operations. Okay, so that is your value at risk. That is also used in a predictive technique. Keeping capital is again the same, that even after product diversification, even after calculating a value at risk, I am still standing to lose some money. So what I'll do, again capital I will mark off, that I can lose so much money in case of a market risk, and in that case please use my capital as last resort. Okay, so keeping capital. Next thing that they do is product level. Okay, so each product also they kind of evaluate. Okay, first thing is product valuation. Product valuation, like you invest in equities, that time you see everything. You see the management, you see the PE ratios, all your fancy ratios, you see how it is doing over the past years, all that things, correct? Same way here also you see all that things and do a product valuation, thinking this is the amount I want to buy. Next is you do monitoring of the product. So it's not only about monitoring, it's not only about buying, it is also about monitoring, correct? I bought this share of say HUL and I'm like chilling. I'm not at all looking at it. But I come to a point and realize that shit, this is going wrong now. It's too late by then, correct? I need to monitor on a daily basis how my HUL stock is doing. Now, linked to this is the third thing that they do. Know the take profit or cut loss limits. Okay, so say HUL I bought for 100 rupees. And now I'm monitoring on a daily basis. From 100, it is going to 90, 95, 80, 85. Now I need to stop somewhere, right? I need to take the losses. I can't let it like hit 50 or 40. So as a bank, beforehand, I keep in place a limit that say after 70, if this stock falls below 70, I'm not going to take any risk. I'm going to sell it at 70. Okay, so that is a cut loss limit. Contrary is also correct. From 100, it went to 105, 110, 115. Okay. Now, if it reaches 110 and it's like a bubble, 180, and it's a bubble and it crashes all the way down, correct? All the bubbles crash. Then also I run a risk as a bank. So I know what should be my take profit limits. That is say below above 140, I will not take any more risk because 140 say maybe decline shuru ho jayega. Correct. So that is a take profit limit. So knowing the take profit and take loss limits are also one of the ways in which banks monitor their market risk. Okay. Going to the next type of risk, We have operational risk. Now this is very, very interesting, and this is where I work like day in and day out. Okay, so operational risk is the losses which are arising due to failure in inadequate process, people, system, or external environment. It is known as mother of all risks. It gives rise to all other risks. Now, if you see, I've put on this man over here who's trying to walk on a rope, okay, from one end of the mountain to the other end. Now, let's see what all other, he's still walking, right? But what are the operational risks he's facing because of which he might stand at a loss? What is a loss for him? Loss for him is falling off this rope, okay, not reaching the other side safely. Let's see first thing. First thing we say is inadequate process in operational risk. Now, instead of walking, this man decides to fly. Okay, he just like flaps his hands and decides to fly. It's not a correct process that he's following. He's not tuned for that process. So he will definitely fly. He'll definitely fall. So that is inadequate process. He's not following a correct process, that is walking, but he's trying something new because of which he's going to fall. Next is people. Say he himself is hungry and he fainted. Okay, he's definitely going to fall. So again, a loss for him. Then we have system. Okay, say the rope cuts down. He is like all fine. He is still walking. He is not at all hungry. He's walking straight, but the rope falls. Okay, so the system that he's using crashes over here. So he will also fall. And the next is external event. Nothing is wrong. Okay, he's not hungry. He's walking. The rope is all tight, but a mosquito comes and bites him. Okay, and he goes to scratch that. So it's an external event that happened, right? But he will fall because of it. So this is an operational risk which the banks faces. Okay, so that's why we call operational risk as mother of all risks. How do banks manage operational risk? It's a very interesting model. It's called 3 lines of defense. It's same like a Swiss cheese model. So if you see that, if you don't know what's a Swiss cheese, you see there's a Jerry here, and the cheese that Jerry eats is called a Swiss cheese. Swiss cheese has holes in it, right? So what we developed as 3 lines of defense is 3 layers of defense. So the first defense that comes is from business. Business itself, tries to avoid the risk. So they have a maker checker. They have someone who is doing the application. They have someone who is checking the application. So they themselves are trying to avoid the risk. So if you see on the first Swiss cheese slice, you have a first arrow where it is yellow, correct? That is the first risk that business itself stopped. But there are other risks going through other holes of it. Okay, then comes risk management, which is a middle department, and that department does something like we spoke about EWS, right? Early warning signals. They monitor key risk indicators, they monitor potential losses, and they try to stop a second level of risk. Okay, so risk management, say only one person was doing that application. When risk management is doing their analysis, a second line of defense is doing their analysis on the business, they will go and tell the business, look, you have only one person doing this, put another person over there. Okay, so even though first line missed it, second line will have it. So if you see on the second cheese model over here, you have another yellow kind of block, which shows that a second risk, even though it went through the first block, the second block stopped it. Okay, then you have internal audit. Now, something that business missed, risk management missed, and internal audit will catch. Risk management is very strategic in nature, while internal audit is nothing but checks. They go, they pick up every file, they will check every file, they will, say, okay, this is the risk, why is this done this way, who approved this, all those questions, correct? So that is what an internal audit department does. And there is where they will catch it, that say, suppose the same example, maker checker, business missed it, risk management also missed it, but internal audit saw that क्योंकि यहाँ पे checker नहीं था, manager नहीं था, काफी सारे applications are just processed, out of, are erroneously processed. That is what internal audit will catch. So that is if you see a third block, and there is again a yellow block over there. So something that passed through block 1, through block 2, was prevented through block 3. Okay, something that passes through all of these. So As long as it's being stopped at some level, it's called hazard, and each level is called loss prevented. But when it goes through all of this and it's still out, no one caught it, then it is loss which is not prevented, which is an actual operational risk loss. So this is how we manage operational risks in banks. So little bit touch base on insurance companies. They do nothing, their risk management is typically the same. Okay, insurance companies, first let's understand what they do. So essentially they guarantee a compensation for specified loss for a specified premium. Correct? Jumping from banking to insurance now. So what we understand is, I'm taking a premium of 10 rupees from person A, and I'm telling that person that in case of any damage, any loss, any illness, I will pay you 100 rupees. Okay. So that is what an insurance company does. So now insurance company is obligated to pay that person 100 rupees. Okay. He might not come tomorrow. He might not come after 1 year. He might come after 10 years, as long as the policy is going on. Correct. So now how do they make business? Matlab, it's not social service, right? Just, give me money and I will just cover you. 10 rupees de do, 100 rupees le lo, right? It's not social service. So what they do with this money is they invest it in the market. So now I receive 10 rupees premium from A, from B, from C, from D, from E. I have 100 rupees. I'm going to, invest that money in the market now. So the interest that I get from that money and the claims which I paid to the insurer, that margin is what I stand to make profits. So again, profit is important. Sorry, risk is important to earn profits. Okay. What are the two essential risks? Here we don't stand credit risk. We stand something as underwriting risk, which is a very different universe. But essentially, if you say important, is market risk and operational risk that we stand here. Underwriting risk is nothing but checking the KYC of that person, checking whether he's a legitimate person, checking whether how much should I underwrite to this person, how much insurance should I give him. If he's a smoker, it will be different kind of insurance amount. If it's a non-smoker, will be a different kind of insurance amount. Correct? So those are your underwriting risk, reputational risk, compliance, strategic. All this remains same as in banking. So essentially, banking or insurance, both are obliged to pay people back. They are not, they are kind of a social, they're kind of a social institution only, right? Where a group of people are putting money and the same group is expecting the money back. So when they're expecting the money back, for me to function as an institution, I need to invest that money somehow. Correct? I need to lend it or I need to give it in the market so that I earn certain interest on it. So to manage all of this is where we come in as risk management, and where we tell banks, this is something you should do. These are the kind of diversification that you need to do, etc. So that's all about risk management. What we understand that it is very vital for business, and that's why it's become a risk management per se has become very vital for banking and insurance. Yeah. With that, I'd like to end my presentation, folks. That's all. Any questions here?
Well, thank you, Siley. I think in a very crisp manner, in a very simple manner, and very layman terms, you have talked about the most complicated terms, what happens in banking sector, banking area, and giving some. This is what you, and let me tell all others who are here, even my BBS student first year, she's also taught the BBS students.
Exactly,
Okay,
exactly. I'm doing this
so
in and out every day.
okay. So she's been doing this and she's teaching our college students also in the future. Right now she's stuck so busy. I know she has been the two quite time constraints are there. So that's why she's not able to teach all this year. But I'll definitely want Siley to come ahead and keep on taking topics whenever she is free.
Yeah, yeah,
So
sure, sir.
yeah. So in a very, very simple and very lucid manner, explain all the important concepts of risk management. Let me tell you, my dear friends, one of the key, one of the most important key areas in any business, or for that matter, today is about management of risk, and that's what Siley told very clearly, that whether you should take the risk or you should defer the risk or transfer the risk to someone. You talk about managing the entire risk process, and every sector has its own set of risk associated with this. Maybe it is a liquidity risk, maybe it is a market risk. If we talk about, suppose we talk about the bond markets, it's the interest rate risk. Okay, so different things are there which Silas very well explained. And now, after this presentation of us, it's your opportunity to ask queries to Siley. Take interest in asking questions and doubts, whatever you have in mental risk. And then one more thing, Siley, with
Mm-hmm.
this, that since we already created our Casa Dinero Club, we already have mentors who are
Mm-hmm.
guiding the students and who will be coming up taking various sessions. I also request you to be a mentor for the students,
Oh, sure,
so they
sir.
can definitely be in touch with you, learn from
Mm-hmm.
you, prepare different projects and models. It may be from any sector, it may be from the market sector or the further any other sector, any other area in the banking and the research sector. So please guide them. You be the mentor for them. You are an alumni, and I request my alumni to mentor the next generation. Okay. So hence here from the floor is open for all the question answers. Any questions
Sure.
are there? Pratiksha, please take the questions and give it to ma'am.
I think I have some questions in private. They've replied to me
Oh,
like privately. Okay.
okay.
The first question is, can you explain again second line and third line of defense? Okay.
Hmm.
As second line of defense, what we essentially do is we tell ki, monitor these kind of things, monitor these key risks, monitor whether each department has a maker checker or not, monitor how many applications a particular person is handling, whether he's handling 4 applications or one. When he's handling 4 applications, it is difficult for him to look at each application with that much concentration as much as he looks for one. These are just few examples, very few examples. So these are certain key risks that we try to identify. We say ki, check how many major people or say like influential people are not there in their respective positions, who have retired or transferred, okay, or who have quit, and these all positions are empty. So track all these operational things is what we tell as risk management to business to track. Now whether they are doing it or not, okay, whether business might give us compliance ki, theek hai, we have appointed someone, but how competent is that someone to actually mitigate that risk is what internal audit does as third line of defense. They will go and they will check that despite of having 3 people, are there still losses? Okay, so we recommended put 3 people, but they are saying ki despite of 3 people there are losses, put a fourth one. Okay, so that is what a third line of defense is. We do not go on ground and sit and audit everything. We do not do tick mark things. That is something that audit does. So that is why they are third line of defense. I hope that's clear. Second one is, sorry.
No, no,
Uh,
continue.
okay. Second is role of an actuary in insurance company different from risk management. So, I talked about underwriting risk, right? Actuary is something which forms a line between risk management and the pricing part of it. Okay. So whether I will give a 10 rupee insurance or a 12 rupee insurance, an actuary model tells us. So they are very much part of risk management, but they need to explain to risk management what they are doing and how they are doing. If I say 12, then why is it 12? So that is something as risk management, we also monitor actuaries ki what they are exactly doing. Okay. So yeah, the role of actuary is like a line between pricing and risk management when it comes to insurance companies. Can you elaborate a little about VAR? VAR is value at risk. Okay. So I say that, for example, say of this 30, say 30 rupees stock, or say for my entire portfolio, it's not stock specific, it's of my entire portfolio. Say that of this entire portfolio which I've invested 100 rupees, 80 rupees is something that I need at any cost. My portfolio from all the sides can't go below 80 rupees. It's something that I have value at risk. Or say that this 20 rupees is what I tend to lose, let me put it that way. These 20 rupees are what I really tend to lose. So that is my value at risk. These are very technical terms. So, when you're actually working through it, there are many parts to it also. There is someone who is doing the calculation, which is a very different team. Someone who is checking that, who is a very different team. Someone who's putting the governance, very different team. So we can't define it per se. Next is, what are other income sources of the bank? So obviously all the facilities that they offer, right? All that locker facilities that they offer you fund management services. They offer you all this, these calls keep coming. I have my bank account with Kotak. So now this guy will call me that, take up mutual funds also through us. So all these are service-based activities, which are other kind of activities through which bank earn. Then is, how can we calculate the stop limit and also the difference between stop limit and stop loss? No, it's whole thing is called as stop loss limit. Stop limit is, bifurcated into two parts as take profit or stop loss. Okay. How can you calculate stop limit? I really can't explain in this session. It's a very, very big process. It's not only that you look, essentially, let me give you parameters through which you will look at your stop losses. First of all, you will look at how much money do I owe my depositors. So all your liabilities in banking terms, the money that is with your depositor is my liability, right? So you look at the liability side of the balance sheet. Then you look at the other asset side of the balance sheet. That is, what are you earning through lending? And then you look at, what was the question? How can you calculate top limit? Yeah. And then you look at how much I have invested. Okay. So essentially what I need to do is, asset need to be equal to liabilities. If it's more, well and good. If it is less, then that should be my stop limit, where it will, go in minus. It can't go in minus. That will be my stop limit. What's the real reason for bank merger? Okay, that's a question. Real reason for bank merger, of course, is restructuring of all these assets. Not one bank is able to take everything. It's kind of, again, a risk management practice of diversification. Very controversial question.
Sahil, there are a few other students also that want to ask the question directly to you. So Atharva, can you unmute yourself and ask the question?
Yes, sir. Hi, ma'am.
Yeah, hi.
How do banking sector deal with the cyber risk? Because it is one of the most growing risks.
With cyber risks, yeah, we have cyber risk practices. Like, there is continuous satellite monitoring going on. There is continuous, monitoring of all these websites going on. Any website which is registered as, say, it's www.kotak.com is the official website. Okay. Any website coming as KK, Kotak, okay, KOTKK, also is monitored through these devices. There are very advanced devices provided by, some of the big market players, which help to identify all of these. Apart from that, there are constant trainings going on. Apart from that, training and awareness, I think, is very general. Apart from that, all these systems are always audited. Okay. There is something called as VAPT, vulnerability assessment and penetration testing, which banks do. What they essentially do is, their own system they'll try to manipulate. They will call some, ethical hackers, and they will, I won't put it as ethical hackers, but, some professionals, which will themselves try to, penetrate or like break the system of the bank. Now, if that is breaking, then a VAPT test is failing. Okay. So there are these constant VAPT tests that they are doing. So a lot of such measures increase security, mainly managed through, tech side only, which are helping banks in managing the cyber risks.
Thank you, ma'am.
Yeah.
Manav, are you there? Okay, till then we have Shrest Toshniwal. Shrest, you can ask your question.
Thank you, ma'am, for that wonderful session. My question was, so when the RBI asks banks, especially private banks in general, to loosen its purse strings. So in these COVID times, when the banks were insisted upon to, give out loans, and the RBI was lending so much, so that the banks then gave out loans, and then there was a contradiction that the banks are not lending enough as much as they're supposed to, and for that reason, RBI was bringing down a lot of interest rates. So how obligated are private banks in that way to lend out loans when the RBI asks? Also,
this is actually, sorry, yeah, go on.
And also, ma'am, so when the RBI then asks banks to lend these loans, so is there at any point of time some risks that you talked about are overlooked, and if not overlooked, underplayed or not taken as seriously as they generally would be, or would taken, I mean, to avoid NPAs?
So answering your first question, yes, this is a dilemma that all private banks, or say all banks for that matter, face. That some benefits are difficult to pass on, and which is, I think, in very public interest, that RBI also says the same thing. It's all over the place. RBI also says the same thing, that it is very difficult to pass on these services. So they are also working on an alternative. Let's see how that comes along, where how they are focusing on how they can directly pass this to the end users per se. Okay, so yeah, there's no straight way we can get through there, but let's see how RBI tackles that. And sorry, your second question was? Sorry, mute.
Just your second question, you can ask the second
Yeah.
question.
Yes, sir. So my second question was, so what kind of risks in such times are overlooked or not taken as seriously as they would in normal times?
All risks are very seriously taken in all the times, very honestly. Yeah, they might ease certain part of it, but they will not completely ignore it. They will not completely say that okay, take how much ever money you want and go. It will never be like that. It might happen that, okay, instead of first they were taking say half of the collateral, now they are taking full collateral. But risk, they will manage it somewhere, whether it is through lending or whether it is through taking collateral. Might be they will give less of interest to the people. Then instead of 4.5, they will now promise only 3.5, because that is only that they can make, that is only that they can promise. So through all these measures, somewhere they will balance out, but all banks essentially have a very good risk management practice. There are
So can I
certain
ask,
very exceptional cases where this breaks, and I think that is true for everything has exceptions. But I think over the last decade, from when Basel and RBI came into picture and tried to give all this very strict guidelines, ki do this to the banks, we have seen drastic change in the lending environment.
can I ask a follow-up question regarding this, ma'am?
Yeah, sure.
So since this government has pushed banks to lend, so how effective would you rate or consider this kind of a fiscal aid in terms of how it then goes on to tackle the COVID crisis that's plaguing us all? How effective would this solution be, considering that banks are also now scared to lend because of the growing NPAs and their own survival rating?
I think everyone will net always survive. Pushing, I think there is always an infusion and diffusion. We have always learned it through inflation, deflation, how interest rates are pushed and how economy is boosted overall. So I think this is one of a very, very economic parameter, or a very textual theoretical parameter only taken. So it won't be very different than what we have seen in the past.
Thank you. So, Saili, I want to ask questions regarding the risk management as such. What I want to know as a coordinator right now, what, since you are the industry, you passed on from BBA, you did the entire 3 years, knowing you were studious all the time, questioning, coming to me, asking questions, what to do, how to do. I remember the days everyone left from the class, you still sit in the class and studying. You went to the lab more than the canteen, the library was a favorite place. So taking all this kind of consideration, taking the fact you're working with Crystal and taking the fact you work with ENY, with this batch or with this coming batch, what skill set they should develop so that they can enter into this BFSS sector?
I think one is know your subject really well, really well. I'll tell you right from my experience. In my first year, I could read the balance sheet of the bank, more easily than my manager could. Okay, because I sat and I've written that balance sheet down, the format, at least 25 times so that I could score in my semester exams. Never thought that, I will have it so much by heart that now I'm reading it, and it was so lucid to read. So all the education that you're taking, do it very, very sincerely. All of it is going to be useful. I can understand an insurance. We got one of a very, very different kind of insurance book to see. Okay, and I was able to understand each of it because I knew the base, I knew the crux of it. Okay, that time Mumbai University was doing the syllabus, and everyone was like, such an outdated syllabus, ye kyun sikha rahe hai, why do we need this? But what if I retrospect, I see is that because I read that books, I know the crux of it, I know the base of it. Right now I'm kind of also working into derivatives and treasury. Now I understand different treasury products or different derivative products because I know on the base what a derivative is, what it should do, what is a futures, what is a option, what is a forward. Exam mein likh ke aaya 2 semester, okay, but I know the base of it. That is why when I'm working, it becomes very easy for me. I've seen at the same level. So I joined from BBI. There were another 2 people who joined from BSc Math, BSc Stat, same profile. The batch after me, again BSc Stat, BSc Math, BSc Eco, BA Eco. Okay, another batch after me, BFM, BSc Math, and I think this course BMS, yeah, same profile. But they faced a lot of problem, being into that and continuing. All of them have left because all of them thought ki, whether I can survive or not. I could survive all through these years as well as skip the job during a COVID period when job was so difficult. Okay, I could secure that job because my bases were very strong in what I'm doing currently. So whatever you're studying, whatever, like absolutely whatever, you take an extra course along with it, whether you're working for whatever club that you're working, whatever you're doing, do it very, very sincerely and put all your heart into it. Only then I think you'll like reap benefits out of it once it's like right under your skin.
Thank you, thank you. That's what Salia was always told, and that's what the reason behind, bringing Casa, bringing the group of Casa, the Dinero, Western's Unite, and learn from all the alumni and the market experts who are right now working, because they've gone through the entire process. So the experience speaks a lot, and young people like you who can connect with today's generation are also an advantage to all of us. So the next, I think Pooja Lalwani ma'am is also there. She also wants to speak something. Pooja ma'am.
Great.
No, I just wanted to say, Sally, you spoke very well. In fact, there are a lot of things, even as teachers, which we are not aware because what's happening in the industry, and we really got that experience or insight from you. So that's the only thing I wanted to say. That's why I
Thanks,
unmuted
ma'am.
myself. So thank you, Sally. Amazing. You spoke really well. It was really nice and crisp, and I'm sure all of them have really understood the basic concepts of risk or how it is applicable in the real world.
Yeah, thanks, ma'am.
So
Welcome, Sally.
I'm glad I could
before I
offer my
move ahead,
insights.
before I
Yeah.
move ahead, I have Atul Sate sir also would like to say some few words here.
Hi, Sally. It was nice and very crisp presentation. And I know a lot of other things about Sally, which all other attendees might not know. So she's not teaching. She never started teaching now. She was teaching for years, different subjects, of course. So I could see that a presentation was made in such a manner that it is a learner oriented. So many times we come across a situation where speakers want to show how great they are, how expert they are, but what is relevant for students or what is relevant for attendees is very few people have that knack of understanding what I exactly want to communicate, and what is the level of students who are going to what is the level of audience who is going to witness and understand and interpret the concept. So the perfect matching was done because of her experience of teaching. So she knows the student psyche, I would say. Of course, about the content of the presentation, definitely it's very commendable. So thank you so much, Saili, once again for being there. And
Thanks, sir.
maybe a few years later, when you are on the other side organizing these kind of webinars on a different platform, you will understand what is going on at present in my mind to see my student growing higher and taking next leap in the career and otherwise. Also to mention that Saidi was a very active volunteer of NSS. So she mentioned about whatever you are doing in the curriculum, whatever you are doing in studies, whatever club activities you are doing, do it sincerely. And she has actually lived each and every word she has spoken over here. So my best wishes to all her future endeavors. Thank you.
Thanks,
Thank
sir.
you, thank you, thank you so much, sir. So, Saili, you should keep on coming. And as I said, now
Sure.
you, with these words, I'll take your words here that you be the mentor for the BBS students and for my Casa club. Okay?
Yeah, sure,
Yeah.
sir. Sure.
Yeah.
Thank
So,
you, sir.
Aparna, please move on to the last proceedings.
Damini, you can give the vote of thanks.
Thank you so much, Saili ma'am, for taking out time from your busy schedule and enlightening us about risk management in banking and insurance sector. It was an informative session and students have enjoyed it thoroughly. I would like to thank our professor in charge, Mr. Rahul Mishra, sir, for constant guidance and your support. I would like to thank my team CASA for all your efforts and contributions in making this event a successful. Then I would like to thank our participants who have attended the seminar, make it lively and interactive. Thank you so much, ma'am.
Thank you. Thank you. Thank you so much, Damnin. Thank you once again to all the wonderful audience we had for the patience listening. Thank you, Atul sir. Thank you, Pooja ma'am. And thank you to all the CASA team for organizing the event. And not leaving this, thank you to our principal. Thank you, who's constantly been guiding us. Unfortunately, she couldn't join us here. So thank you to the principal and the vice principal. And of course, to our beloved university, our college, and its board for constantly encouraging us to conduct such kind of events and keep growing, keep learning. Thank you so much once again. This is Casa signing off. Thank you.
Thank you. Bye.